Welcome to Alpha Recap, your after-hour synthesis of the day's market movers. I'm glad you could join us. As always, if you have questions, you can reach us at stockalpha.ai.
Thanks. Great to be here. Lots to unpack from the session that just closed.
Right out of the gate, the day featured two competing narratives that really set the tone. On one side, we had a broad tech pullback. On the other, fresh private market validation for enterprise AI infrastructure.
Yeah, that tracks. The headline was pretty stark. More than two-thirds of tech names were at least 20% off recent highs by the close. That undercut momentum, especially in semiconductors and AI-exposed names.
What really stands out here is the scale of that unwind. Momentum players probably felt it most.
Totally. I mean, when you step back and look at this, profit-taking after a big run into the second quarter was a predictable dynamic. But there was another, almost opposite signal: private capital continuing to flow.
For example, Samba Nova landed fresh funding and a strategic tie-up with JP Morgan. The company was valued at $11 billion in that round.
Right, and that matters. Private financings at elevated valuations, especially when paired with strategic bank-level partnerships, are institutional validation that enterprise customers are building out AI stacks. So while public momentum cooled, structural demand signals stayed constructive.
Quick reaction: that creates almost a tug of war between short-term price action and longer-term fundamental adoption, right?
Exactly. Short-term momentum was definitely challenged, but private flows and strategic partnerships compress the odds for long-term adoption. Analysts have been saying conviction needs to be measured against reprice risk.
Moving on, there were a bunch of event-driven items that landed today. Let's talk about earnings calendars and implied volatility.
Sure. Public Storage set second quarter results for July 29th after the close, with a call on July 30th. That's an important catalyst for the REIT space, since earnings commentary can quickly re-rate yield-sensitive assets in the current rate environment.
And options markets were signaling event risk elsewhere. Johnson & Johnson options priced in about a 4.3% move around earnings.
Right, and to unpack that a little for listeners, that implied move is typically derived from a straddle, buying a call and a put at the same strike. It's the market's way of saying how much price action traders are paying to insure around an event. So a 4.3% implied move raises hedging costs and affects how traders size positions into earnings.
Short reaction: options costs matter a lot for event-driven strategies.
Right. And the other thing is, implied moves also tell you where market uncertainty sits, even if the underlying fundamentals haven't changed materially.
Let's pivot to sector-level dispersion. The article highlighted divergence across financials, healthcare, and consumer staples.
Yeah, and it was pretty pronounced. OFG Bancorp, for example, has been a standout, up about 140% over 5 years, trading around $49.88. By contrast, Town Bank returned only about 3.1% over 6 months, trading near $36.27. So you get outsized winners and laggards within the same broader category.
Healthcare showed dispersion too. HCA Healthcare was down roughly 11.6% over 6 months and was trading around $423.55.
Which is a reminder that hospitals and operators can face sector-specific pressures that diverge from broader market performance. And consumer staples aren't immune either. Evercore flagged second quarter risk for PepsiCo related to softer consumer demand. So the so-called defensive buckets can still see cyclical shocks.
Short reaction: defensive does not mean immune.
Honestly, I was a bit surprised by this one. You expect staples to be stable, but consumption patterns matter, and they can quickly compress growth and margins.
Let's talk profitability narratives. Salesforce was mentioned as an example where the market may be behind the fundamentals.
Analysts pointed to material margin gains. One referenced metric was about 33%, and argued that market pricing may still reflect an older, lower profit growth story. If margins keep converging with higher margin peers, the valuation conversation could change. though timing is uncertain and depends on durable revenue and margin trends.
So basically, improving profitability can be nuanced. It doesn't automatically equal an immediate re-rating.
Exactly. Market multiples often lag fundamentals. A sustained improvement helps, but breadth and macro context matter for when the market reprices.
Another big theme was fiscal policy and bond market risk. The research we talked about flagged Social Security trust fund depletion around late 2032.
Right. The point is that delaying reform raises the probability of fiscal shocks that could push yields higher over a multi-year horizon. Fixed income investors were advised to incorporate that policy risk into duration and liquidity planning. So it's less about tomorrow's trade and more about multi-year stress scenarios.
Short reaction. Policy timelines can influence long-term bond market behavior.
And to add to that, it's not just abstract numbers. Higher yields on fiscal risk can feed into borrowing costs and valuation models across equities, especially yield-sensitive sectors.
Let's run through the clash points, where views diverged most strongly in the notes today.
First, AI's near-term path. Tactical skeptics point to those 20% plus retracements across tech and semiconductors as signs that momentum was cooling. Structural bulls counter with private funding and strategic partnerships like Samba Nova JP Morgan, saying adoption is still happening under the surface.
Second, valuation versus fundamentals in software. Salesforce and Datadog were both examples where improved profitability or product differentiation exists, but the market hasn't fully priced that in yet.
Third, macro versus company-specific risk. Evercore's PepsiCo caution and the Social Security research show how top-down risks can blunt company stories. So even if a business is strong, macro can matter a lot.
Quick interjection. 2 to 3 sentence reactions only. What should different investor types have been watching?
Growth and AI-focused investors needed to weigh momentum reset risk versus private market validation, measuring conviction against entry points. Income and REIT investors had to pay attention to Public Storage's upcoming second quarter release on July 29th and the call on July 30th. Fixed income investors should have looked at policy timelines and stress-tested duration, and options traders should have priced elevated premiums. Remember the Johnson & Johnson implied move? About 4.3%.
Short reaction. Event calendars mattered today.
Right. And I'll add a practical note on metrics to watch. Tech breadth, private funding announcements and strategic partnerships, options-implied moves around earnings, margin trajectories for software, and key policy dates that affect fiscal math.
Let's close with clear takeaways listeners can act on when they're reviewing portfolios. And remember, this is analysis, not advice.
First takeaway, price momentum in tech was challenged. Expect volatility. So align holding periods with conviction. Tactical traders should be ready for further breadth swings.
Second takeaway, private market validation and strategic partnerships are constructive signals for long-term AI adoption, even if public price action cooled.
Third takeaway, event risk was front and center. Upcoming second quarter reports and options-implied moves change hedging costs and position sizing. Watch those earnings dates and implied volatility levels.
Fourth takeaway, policy timelines, like that late 2032 Social Security projection, increase the importance of fixed income stress tests and duration planning.
And fifth, look for convergence signals. Sustained margin improvement in software without multiple expansion is meaningful, but markets may take time to catch up.
Final quick reactions, 2 short lines from each of us. Ready?
Yeah, absolutely. Markets closed with a clear momentum reset in tech.
And private capital kept signaling that the AI story isn't dead, it's just more complex.
Big move. Keep an eye on catalysts and implied volatility.
Thanks for joining. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly, and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Reminder, this discussion was for informational purposes only. Analysts note the metrics and market signals for context. This is not personalized investment advice or a recommendation to buy, sell, or hold any security. Check with your own advisor before making decisions.
That's it from Alpha Recap. We'll be back after the next session with another synthesis. Good night, and thanks for listening.